Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. This episode is brought to you by Stream by Mosaic. You can find them at streamrg.com. Stream is an expert interview transcript library that's become integral to my research process. I first discovered them about a year and a half ago, and since then, I've watched them build out an incredibly robust transcript library. It's somewhere that I go whenever I need background information on a company, and it is invaluable to me. Stream by Mosaic provides over 300 expert interviews per week. 70% of their experts are found exclusively on Stream, and each interview goes through 3 layers of compliance screening. Recently, someone said Stream is table stakes for good fundamental analysis, and I couldn't agree more. Please see streamrg.com, where you can use the promo code BREW to sign up for a 14-day trial in order to get a more robust understanding of any company that you're interested in. This episode features Chris Cerrone, a partner at Akre Capital Management. Akre Capital Management is best known, among my colleagues at least, for their patient approach, long-term focus, and selection of high-quality businesses. I enjoyed talking to Chris immensely. I hope that all of you enjoy as listeners. There's no need for me to ramble on when you've got an hour and 50 minutes of Chris to listen to. So, as always, none of this is investment advice. We are not your fiduciaries, and we are not your investment advisors. You know the drill, so get your own advisor and do your own work. Nothing discussed is a solicitation or invitation to buy or sell a security. Please remember that the securities identified and described throughout this podcast do not represent all of the securities held, purchased, sold, or recommended for ACM client accounts. As a listener, you should not assume that an investment in the securities identified was or will be profitable. Past performance does not guarantee future results. Everything expressed here are the opinions of Chris and I. This is all entertainment, so please keep that in mind as you listen and enjoy the show. We're going to get to Chris the investor, but we're going to start with Chris the Josh Waitzkin fan here. And we were having a brief conversation, and then I just said, whatever, let's turn on the mic and start recording. What we were talking about is how limited the feedback loop can be in investing, and how it would be nice to have some sort of idea or product or whatever that would allow you to get feedback in real time, almost like a paper trading, but a paper investing product. Mm-hmm. And then we started talking Josh Waitzkin, and I said, let's just go and record this. So that's the background for people that are just coming in.
So should we give a little background on who Josh Waitzkin is,
sure,
just in case?
Yeah, okay, man. You're driving this conversation as much as I am.
All right. Do you want to do it, or do you want me to
No, you do it. I had Adam Robinson on, and Adam's friends with Josh. But I think you know better than I do, Josh. You seem to be a big Josh Waitzkin fan.
Well, so I consider him a mentor of sorts, even though we've never met. He doesn't know that I exist. It's mentorship in the spirit that Derek Sivers talks about in an essay that he wrote called How to Ask Your Mentors for Help, which I recommend checking out. The thing with Josh, to me, is that he's an inspiring example of someone who, to use his own words, sort of embraces his funk. He lives his life sort of unapologetically true to himself. And there's some other people out there who I would describe that way. And those are usually the people who I gravitate towards and who I have just the most respect for. He is a very private person, but he wrote a book, The Art of Learning, which is a great, great read for anyone who hasn't picked it up.
Josh is the kid who they wrote Searching for Bobby Fischer after, right?
Exactly. So he was the subject of Searching for Bobby Fischer. He was a chess grandmaster. He basically learned how to play in Washington Square Park in New York City against the guys who play there. Sort of rain, sun, snow, what have you, they're out there playing. And he learned a very sort of, I think, scrappy, intuitive form of chess. And the book is great because it chronicles his evolution. He became just passionate for the game. He loved it. And then somewhere along the line, they started trying to teach him the proper way of playing chess, and he lost the love for the game.
Hmm.
And I think that really
Dude, that
seems
happened to
to
me with
inform a lot.
golf.
Yeah, yeah.
Yeah, when I was growing up, I was a field player, and
Hmm.
I think I was reasonably good. I mean, I wasn't like I don't know, I was somewhere around a 3 or a 5 or something like that. But to get to the next level, it got so like technical, and there were I don't know, it took the fun out. And then I started dating somebody and said, I'm too far away from being great and I'd rather, date somebody. But it's an interesting comment because I feel like once I got really, really technical in swing thoughts, I lost part of what made me good.
We'll pin this up because we'll come back to this, I hope, because I think this one of the most interesting things that he talks about is the importance of sort of doing it your way. That if you follow someone else's path, you'll never achieve that sort of world-class performer status, because you have to really embrace the core of who you are in whatever it is that you're doing, whatever art or activity, in order to be really great. But anyway, so Josh, in addition to being a chess grandmaster, was a Tai Chi push hands
Yeah,
world
that's right. He
champion
got
as
into this.
well. He's tackled Brazilian jiu-jitsu. He tackled multiple sort of mountains, I think, as he calls it, in different disciplines. And then he realized, he sort of sat back, I think, and he said, "Look, these seemingly unrelated, activities where I've had this tremendous success. What do they share?" And the realization he had, which led to the book The Art of Learning, was it was his approach to learning um, these disciplines that allowed him to become world class. And so he sort of both writes about himself in the book, but also shares some of those sort of lessons that he picked up. So anyway, I think it's fantastic. And so somebody asked him, as you're so he's his new, and this is as of a little while ago, but the last time Tim Ferriss interviewed him, he was talking about how he is trying to learn the next mountain, which is climb the next mountain, which is this foiling, which is a form of surfing, I guess,
I watch it on
where
Instagram a lot.
you're out of the water, right? And
Yeah.
there's a fin, and that's in the water, and it's very fast.
Yeah. Yeah. It's pretty cool.
It looks
I'm pretty
amazing. And
sure it's
so,
what Zuckerberg was doing when he was holding the flag on the 4th of July or whatever.
is that right? Okay.
Yeah.
Uh, and so what Josh did, and this is where it comes back to what we started talking about with the reps. I guess he figured out a way to put a motor on one of these things so that he didn't have to wait for the waves. He didn't have to get dragged in by a jet ski or sort of paddle through. He was able to motor out there and
Hmm.
just increase the number of reps that he had on different waves and different falls, to the point where maybe he could get in 1,000 days worth, in a week or something like that, what he would have otherwise been able to do.
Hmm.
And because when you're surfing, I'm not a surfer, but I think you wait a while between being able to catch a good wave to practice on. And so then the parallels to investing are obviously there, which is we get a limited number of reps. And unlike surfing, I guess, where you would pretty immediately get some kind of feedback if you found yourself being pounded under the wave or eating sand or something like that. For us, we often have to wait years before we really get definitive feedback as to the success or failure of an investment. And so the idea was, somebody asked him, they said, well, if you were an investor, how would you increase the rep frequency? Like, how would you increase the speed of that feedback loop? And his answer to the question was, well, he went in a different way. And actually, our mutual friend, Jake Taylor, is sort of pursuing this, I think, a little bit with this idea of somatic feedback. So
Yeah.
paying really close attention to the physiological and mental state you were in when you made the decision. So how many hours of sleep did I get last night? How do I feel? Am I agitated? Am I comfortable? Am I relaxed when you're making these decisions? And then tracing back the outcome of the decisions to the somatic state when you made the decision. And then hopefully, and you can, there's so much information now, you have the watch, right? The Apple Watch that tracks VO2 max and your heart rate at all times. And there's the Dexcom where I guess you can track your blood sugar levels,
Oh
on a
yeah.
continuous basis if you
Don't you have
wanted
like a little
to.
needle in your arm the whole time?
I think so. I'm not a big fan of needles, so the idea doesn't work super well for me. But yeah, exactly. And so you could track all of this, and you could have a decision journal that doesn't just outline, how could this be the greatest investment I ever make? How could this be the worst investment I ever made in valuation at price at time of decision? But what your blood sugar was and how many hours of sleep you had gotten and whether you'd worked out. And so that was Josh's response, which is really interesting. And I think could be, fascinating. But the other idea that kind of came to my mind was, could you create, using historical case studies, anonymized situations where you had a software program, you opened it up and it said, okay, here's this business, and it could be something from 1993. Here are the transcripts. Here's the management team. Here's the financial statements. Here are a couple industry reports, something. It gave you some amount of information, but made it so that you didn't necessarily know which company it was, so that there was some chance that you could kind of come at this without hindsight bias, right? And knowing
Yeah.
what ultimately took place. And then you made a decision based on that. And then it immediately told you how that situation ultimately played out over a long period of time. And you could just dramatically increase the number of reps. I mean, for a trader, you would think that would be a lot easier to do because there would just be so many short-term intervals that you wouldn't necessarily know. But if somebody put the sort of American Express salad oil scandal before you, you probably, if you're a student of business, you probably would identify what that case study would be, and then you would know how to answer it. And so the tricky part would be trying to anonymize it so that you didn't already know. But I think then, you just, like any software, good software program, you sell it for a subscription fee to all the professional investors out there and all the traders, and you're in business.
Yeah. It's so interesting to watch. Like I'm sure you have been through like my tenure as an investor is maybe 5 years since I've like known what I've been doing, right? And the QVC fire is something so I own QVC, and they had this big distribution center that had a fire, and I have never lived through having 20 to 30% of my fulfillment capacity taken offline.
Mm-hmm.
And like I didn't have some framework to work through of like how big of a deal is this. And the best I could do was call, my contact over there, and she kind of walked me through how they were thinking about it. They didn't even know, right? There's tons of She was like, look, people want answers right now. We're more concerned with employee safety. Like people still can't even get in the building. Is everything okay? They're like very real world operator questions that people have,
Mm-hmm.
not a spreadsheet. And I think it's an example. I mean, I think we're recording on the day that Netflix is off 20%, but people are experiencing a growth pocket and a long-term secular thesis. There's these things I think you almost have to live through to really know how you're going to respond. But living through it, how how do you prep yourself for that is really difficult, I think, as an investor.
Well, I think there's, I've been fortunate, right? I've worked with and sort of learned from Chuck Akre for the last 10 years, right? And so one of the things that Chuck brings, which is always super valuable from my point of view, is he has that collection of experiences, that's sort of cumulative over all those years, and he can draw on past events and that have parallels to what's going on today, and that can be really helpful. And I think that's why, as you go along, investors get better, uh, up into a point, probably. And so if you could somehow increase the reps, then maybe you could accelerate that a little bit.
Am I circling back to Josh, am I correct that he said that the way that he learns is slowing down? Like when he was learning push hands, didn't he practice a motion really, really slowly to train his muscles how to do something?
Yeah, I think he calls it sort of the mastering the micro in order to master the macro, or something. I'm paraphrasing, and I'm sure he said it a lot more eloquently than that. But yeah, I think that is exactly what he does, and I think you can do that in this example as well with investing, where you could take micro examples and say exactly, to your point about Netflix today, instead of trying to get Netflix the 30-year history exactly right from an investment point of view. Maybe it's just, what is the proper response today based on the information that you've been given over the next 3 or 5 years or something like that. Or even something smaller and more micro than that, and look at transcripts and say, should this comment that was made in this transcript in the third quarter of 2016 be taken as important or not?
Hmm.
And I think that's something that we think a lot about here, because of course we're, as we try very hard not to sell our businesses unless it's absolutely necessary to do so, and there's a lot of noise, and you're trying to sift through all that noise and make some sense of it and determine whether or not something's a relevant data point or not. And one of the things that we do to try to resist the urge to sell or to trade in general is we do essence statements. So we write down, it can be a sentence, it can be paragraph, but you're basically trying to get down what the real key idea is about a business. And then the other thing I do, and it keeps coming back to Josh Waitzkin, but he tells us about this most important question exercise, where I think the way that he uses it is, at the end of the day, he basically asks himself, what's the most important question that I'm facing right now? And then he turns his mind off and he sort of lets his subconscious work on that overnight and then
Hmm.
revisits it in the morning. What we do is we try to write down what the most important question or questions are for all the businesses we own. And then what's really important that you do as a follow-up to that is you do what he calls gap analysis. So how has your articulation of those most important questions changed over time? Because that will show you a little bit about how the evolution of your understanding of a business is changing over
Hmm.
time as well. So you don't want to just have a Word document which you resave every time you change them. You want to at least have a PDF somewhere where you've documented
Yeah,
what you
redline
thought
it
as
or
of.
something.
Yeah, exactly. And then you track that over time. And
Hmm.
when you have that essence statement, or you have that most important question, and then something comes up on the second quarter call, you just look back to that and you say, well, does that impact in a material way what I've written down as being the most important question, or the most this essence statement? If the answer is no, then it makes it a lot easier to sort of set it aside and not get too agitated about it. And if the
Hmm.
answer is yes, then you can dig
Then you have
further.
work to do.
Yeah, exactly. Then you got to roll up your sleeves and get after it. But it's a great filtering mechanism, I think. We find
Yeah.
it really helpful.
So, man, all right. So first, subconscious working on it. Is this why you're interested in meditation a little bit, do you think?
I think for meditation, to me, the what I think meditation holds the key to is being a little bit more present, which
Yeah.
is something that I think is a major work in progress for me. It's just something I've as diligent as I am and as disciplined as I am about getting enough sleep at night, or eating clean, or getting to the gym. I've struggled my entire adult life to cultivate a consistent, meaningful meditation practice. It's just one of these things that I haven't done well. And I have also sort of struggled to be as present as I would like to be. And I think the two probably go hand in hand. But no, I haven't really tried to do the subconscious MIQ overnight and then sort of wake up in the morning and journal. That's kind of the best practice, I think, is you write down at the end of the day what that most important question is. You go home, you spend time with your family, you sleep on it, you wake up in the morning, and before you check your phone, before you look at email, you look at the news, anything like that, you just journal.
Start writing on it, huh?
You start writing, and you get that discipline.
This might be a Tim Ferriss thing, but it could be Shane Parrish too. I don't know, but stop mid-sentence when you're writing.
Mm-hmm.
Right? So like write the most important question and maybe start one more sentence and just stop halfway through.
Yeah.
I think that's pretty cool.
Said that because that was his way of sort of, because then if you stop the sentence halfway through, then you know exactly where you have to pick up the next day, and you get momentum. You're already moving in the right direction, because sometimes if you carry it all the way through to the end of that thought and you end, or the end of that task, and you close your book and you go home, then the next day you get to your desk and you're looking around and you're like, well, what am I going to start with?
Yeah, you got writer's block all over again.
Yeah, exactly. But if you've got something half written, you just finish that sentence and now you're rolling.
Ah, that's really smart. I thought that it was because your mind would keep working on it overnight.
Well, that might happen too.
Yeah, I like the idea of it gives you something to write.
Mm-hmm.
Something that was interesting, I think that Adam said it on Jim O'Shaughnessy's podcast that the three of us did together, but I had asked Adam, or maybe Jim did, this concept of reading 500 pages a day or a week or whatever, however the legend has morphed, right? And Adam's comment was, he said, I like to read one thing and then really focus on it. Mm-hmm. So I think going back to your idea of simplification, getting a lot of bang out of the buck of the work you're doing, rather than thinking about 5 different places or trying to churn through info, certainly has helped me a little bit. I don't know. I got a long way to go on this.
Well, I think focus to me is one of the sort of keys to how we approach investments. There's a great line by Phil Fisher, goes something like, I don't want a whole bunch of good investments. I want a few outstanding ones, which goes to that issue of focus. And so and I think it can be hard to keep up with everything. I mean, all the documentaries, all the podcasts, all the new books that are being written all the time. I mean, it's overwhelming, right? And I like Tim Ferriss very much, and so I've subscribed to his 5-Bullet Friday, and sometimes I just have to say no, because there's so many little things in there that I wanted to read or watch, and I just have to stay focused on what I'm working on. A lot of times the best thing to do is just to go back and reread something that you already know. It's on the bookshelf, right? And it's in the part of the bookshelf where you put things that you want to reread.
Yeah.
The other 80% is stuff that I'll probably never look at again. But that one right there, those are the things I want to reread.
Huh.
And you go back, and I think you just get a lot more out of it sometimes. You see something resonates with you that didn't resonate the last time you looked at it. And so anyway, I think there's a lot of value in just being really focused.
Huh. I like that. I'm thinking of some of your answers that you provided me with, and books that I should reread Shantaram. That's the thought I have. Anyway.
Well, I'm halfway through.
Are you?
Yep.
It's fantastic.
Yep. It is. It's beautifully written. It's a very long book.
It is long. People ask me what it's about. I'm like, well, life, love, drug running, escaping prison. Like, I don't know what they don't cover in that book. India, but it's incredible. So
the audiobook is also, that's how I consume most books these days, is by listening to them. And there's a pretty outstanding narration actually on Audible.
The audiobook you got to listen to is Sam Zell's.
Oh, really? Okay.
Oh, yeah, because he reads it.
Those are the best.
And it's in like that raspy voice that he's got. It's amazing. So anyway, let's talk about Akre Capital and your firm and whatnot. Or I apologize if I said it wrong. If I did, is it asset management? What is the official title of your firm?
The official title is Akre Capital Management.
There you go. All right.
Yeah.
You want to inform people on the three-legged stool, and then we can get in a little to some of the more advanced concepts.
Yeah. So, I mean, if you don't mind, maybe the thing to do is a little bit of a history lesson to start, because I think that might interest people, because I think it's hard to understand Akre Capital without knowing Chuck and understanding Chuck.
Yeah.
So will you indulge me for a minute?
I'll tell you what, I would love to. Chuck is like a hero of mine. Everyone that I respect loves Chuck. I got to talk to Chuck for like 2 minutes once, and I asked him if Telesites was the next American Tower. And he looked at me and he said, "Son, American Tower might be the next American Tower." And I said, "All right."
Exactly. And what'd you do about it?
I didn't buy American Tower, and here I sit poorer.
Okay. All right. So the story for Akre Capital, I think, kind of starts summer 1968. So we're going back a little ways, and that's the time when Chuck became a stockbroker in Washington D.C. Worked for a business called Johnston Lemon, which was one of the sort of premier Washington D.C. based investment banks back then. Brought Marriott public, for example. And in his own words, he described himself as a know-nothing back at that point. He had an English degree. He had been pre-med at one point, but he had no formal business training of any kind. And so he started off by asking some pretty basic questions, like what makes a good investment? What makes a good investor? He was basically just trying to solve this investment puzzle, right? That we all struggle with.
Man, imagine Chuck Akre not like as a know nothing. That's insane.
Blank canvas.
Yeah.
Nothing. Just entirely. He actually said that he'd taken one of those vocational quizzes. It says, what do you like to do? And then it tells you what you should go be when you grow up, kind of thing. And this is what it told him. So anyway, so he's trying to figure out the investing world in 1968. And there were sort of two books, I think, that really made a big impact. One was John Train's Money Masters, which is, by the way, in that group.
I like that book.
It's one of the best.
That's a good book.
It's fantastic. And every time I read it, I get something new out of it. And in that book, John Train interviews Warren Buffett. And Warren provides a list of what makes a good investor and what makes a good investment in that chapter. And as Chuck says, I don't think he's ever gone and said all of that in such a concise way anywhere else. So that made a really important imprint on Chuck's early thoughts about what you look for in an investment. In fact, since everyone's going to say, well, then what does it say, right? Well, might as well tell them. Wonderful businesses, there are 4 characteristics: good return on capital without accounting gimmicks or lots of leverage. Understandable businesses, one should be able to grasp what motivates the people working in them and why they appeal to their customers. That's 2. They see their profits in cash. That's 3. And they have strong franchises and thus freedom to raise prices. That's 4. And then in terms of the list of what it takes to succeed as an investor, he says you have to have 6 qualities. First is you must be animated by controlled greed and fascinated by the investment process. That's 1. You must have patience. You must think independently. You must have the security and self-confidence that comes from knowledge without being rash or headstrong. You have to accept it when you don't know something, and you have to be flexible as to the types of businesses you buy, but never pay more than the business is worth. So that made a really big impression on Chuck in 1968. And then the other book that he came across in 1972, 100 to 1 in the Stock Market.
That's a great book.
Which is a classic.
And you know what? That's seasoned really well.
Yeah.
And then Chris Meyer did a re-up of it with 100 Baggers.
And he did a great job with that. And I think sort of re-energized the original too. I bet you the book sales went through the roof after Chris's book came
Yeah,
out.
that's probably right. I know that's how I bought mine.
Yeah, and so 100 to 1 was written by Thomas Phelps, who was an investment manager based in Boston back then. And what he did in the book was he went back and I think he looked at 300 or 400 businesses that one could have purchased between basically 1932 and 1967, and they still would have returned 100 times your money by 1972. So there were, a few hundred baggers basically that he sort of chronicled in the book, some in depth and some in list form. And so the big takeaway for Chuck from that was the importance of compound returns. And I think that sort of sets this whole thing into motion. The whole Akre Capital sort of comes out of that. And so what we say is we focus on rate of return here. That's sort of our North Star. Chuck likes to say that the bottom line of all investing is rate of return. We actually have it written on the crown molding of our conference room.
Oh, nice.
There are 3 other things written on the crown molding of our conference room that we may get to organically as the conversation goes along. We'll see. One of them is focus. So we already touched on that. And what he did was he looked back and he said, okay, let me study the historical rates of return for all these different asset classes over long periods of time. And what you find out is that public companies that are based in the US are a pretty outstanding asset class. They've compounded at basically 10% on average annually over the past, at that time it was 70 years. If you carry the analysis through to today, it's still roughly 100%, 10% rather, over now 100 years on an unlevered basis. And so what we say to our clients is that our goal is to compound their capital at an above average rate. So we're trying to meaningfully exceed that 10% long-term average. And the way that we do that, the sort of the foundational notion that we have, it goes back to those attributes of a wonderful business from John Train's chapter on Buffett, is we're trying to buy businesses with above average rates of return on their invested capital, that are purchased at reasonable valuations, that are managed by outstanding teams, people who have both skill and integrity, and who can reinvest their capital at high rates going forward. And that's 3 legs. So a lot of people who know Akre Capital know that we use the 3-legged stool as a construct for what we're looking for in finding these sort of above average businesses: business quality, people quality, and reinvestment. And so that's kind of the firm in a nutshell. We're based. I can't tell you about Middleburg, Akre Capital, without talking about Middleburg, Virginia, really quickly. Do you know Middleburg?
I don't. I know Richmond, and I like Virginia a lot, but I don't know Middleburg. I assume it's a smaller, sleepy town, and the people are really good people. That's my assumption.
So it's a small, as we have, I think, an official census population of 500
Wow.
here in Middleburg. It's sort of in the Virginia Piedmont. I think it was originally, its original claim to fame was that Jackie Kennedy would come here to ride horses.
Huh.
When the Kennedys were in the White House. And so now it's a sort of 3-street, 1 traffic light town with sort of some restaurants and shops and a sort of higher end resort. And then here we are managing capital in what used to be a tavern that, prior to being a tavern, was a Ford dealership.
Wow.
And we've remodeled the inside, but the exterior looks the same. As so occasionally somebody will come and tap on the glass and say, is the tavern open? And
That's
and there are
awesome.
13 of us. There are 5 of us who do investments, and 13 of us total. And I like to compare it to, so New York City, I don't know, do you have a guess? This is a fun game. How many traffic lights there are in New York City?
Oh man, no, I don't. I don't even know how to. I'd go through it on a podcast.
13,000, I believe. That's what Google tells me anyway.
Huh.
So I just like to say we simplify things. We went from, I came from Goldman Sachs. That's where I started my career out of school. I was there for a couple of years, and then in 2012, 10 years ago, I came down to Middleburg to work with Chuck, and so from 13,000 traffic lights and 8 million people to 500 people in a single traffic light. So we
Yeah. What
simplified
made you
things,
say
and
yes?
it was Chuck. I mean, it was the opportunity to learn from somebody like that. And I was 24 years old, completely blank canvas for the most part. And it was the sort of the idea that I could learn from, this legendary investor.
He was
And
already Chuck Akre at the time, like, because I feel
he
like he's
was,
become legendary over
yeah,
the last, I don't know, 10 years, or maybe I just know him now.
so he, I think over time, it's definitely his popularity has increased since the time when, or I guess it's it's the number of people who've gotten to know him seems to have increased in the time since I've been here. But at that point, it was still very clear, based on his investment track record, that he really was, a great investor and somebody who was interested and willing to teach me. And so that was just hugely appealing. And honestly, I was never a big city kind of person. And so I welcomed the opportunity to come down here. In fact, I learned how to ride horses since I moved here.
Oh yeah.
Yeah, that was a thing. So, I've embraced Middleburg.
I would ride
And
horses, but I'm like deathly allergic.
really,
Yeah, I when
to the
I learned to ride when I was a kid. My grandma's got some horses, and like I would just be, it was just snot everywhere. It was a terrible experience for me.
is it
But
the
I like
fur or is it the
horses.
hay?
I think it was something that they were spraying on them in the barn actually. But
Oh,
because my dad has some horses, and when I see them, I'm not quite as allergic. But like cats get to me. Hopefully, dogs. I grew up with labs. I'm about to get a golden
hmm.
in like 3 weeks, so hopefully I'm not allergic to dogs. We'll see. I
So
don't
I
think I
have
am. I
a
grew up with them.
so I have my assistant,
Yeah, you got a
which,
black one, right?
yeah, and if the people who watch this, well, I don't know how to do this, but anyway, he's lying on the floor right next to me, Duke, and he's just a fantastic dog. Labs are wonderful.
We had a
Um,
yellow one, big box head. His name was Ringo. Dog was just like Marley, except like a moose. And then we had a black one, Ruby. She was fantastic. So I don't know. I hope the kids. I know my second specifically. I think he feels. He's a middle, so I
mm,
think the dog will be good for him.
they're the best.
Yeah,
They're the absolute best. Um,
unconditional love.
yes, exactly. Yeah, and so that's kind of in a nutshell what. And I thought that you might. Well, let me throw in three other quick things about Chuck, and then I think I have some things that might interest you, some Chuckisms. Since
Dude, I'm telling you, I'm here to listen. Whatever you want to talk about, I'm here for.
All right, so all of that. So Chuck taught me all these. We talked about the power of compounding and not selling unnecessarily. A couple other things just to note, I think. So we run a very concentrated strategy. So if you go back over the years, typically the top five holdings account for anywhere between 50 and 70% of the assets in our portfolios, and low turnover. So typically less than 10% each year.
Can I ask you a
Uh,
follow up on this?
yeah.
All right, because I'm curious. When when you let a position grow, how do you think about portfolio construction?
Hmm.
Either as a static portfolio or as new money comes in? Because this has been one of the things that, as I've studied your writing, specifically The Art of Not Selling, I've like thought of a little bit. And David Gardner, who I also interviewed, I mean, I think when he lets things run, like he gets pretty concentrated, and you got to be comfortable
Hmm.
with letting it run. So it's something I wanted to ask.
So well, let's start with the static portfolio because that's a little bit that's a little easier. So if you have a static portfolio and certain things are doing well, it's absolutely our preference to allow them to grow in size up into a limit. And the follow up question is, well, what's the limit? And it depends. So in some cases, so we manage a mutual fund, and there are explicit diversification requirements imposed upon us by the SEC.
Yeah.
And so that dictates to some degree how concentrated you're able to allow the portfolio to get.
Isn't that why you
But
guys had to buy? Not that you don't like S&P Global, but wasn't it like you got to your limit on Moody's or something, and you had to get S&P also? Is
yeah,
that
so your American Tower sort of preferred SBAC became sort of the double down. We own Mastercard, and then we were able to sort of increase our exposure to that business model by buying
via Visa?
Visa.
That makes
Yeah,
sense.
exactly, and so the that helps a lot. And so even though the mutual fund has 22 holdings, there's some sort of repeats in there, right? That make the number of business models per se fewer. We have both KKR and Brookfield Asset Management, for example. So again, it's sort of giving you exposure to the same major trends and themes. But in sort of an unconstrained portfolio, the size of the positions can get in excess of 20%, and that doesn't cause us any sort of indigestion. I think if pressed on what exactly the max would be, I think if you go back and look historically, as you get closer to 30, I think there's been an inclination to sort of pare back. That hasn't happened recently, but that's so the idea of trimming is one that we just don't really trim, and we don't there. It kind of goes to a bigger issue of optimization, and so this idea of sort of portfolio optimization. And I guess what I've learned from Chuck is that in some ways optimizing is insatiable. So and I
Hmm.
think there's a certain amount of humility that comes into play where you say, I'm taking I'm taking money out of this business that's doing really well, and I'm reallocating it over here to something that hasn't done as well. And I'm right in both of these instances. Whereas if you sort of allow a business to run, you're sort of they're earning their position sizing as opposed to sort of you dictating. And so there's not a lot of that optimization that goes on. Not
You
a
know
lot
where
of
I screwed
trimming and
up?
adding.
I'm trying to add value to the conversation. I'm curious to hear your take on this. Like this happened to me with Charter, right? And I funny enough, you were talking about transcripts that had things 3 years ago. When I got involved in Charter, the reason I got comfortable with the integration issue is I was reading old transcripts and they called it out as an issue. And when I was at BMO, I had lived through an integration. It just kind of made sense. But here I was looking at Altice, which, it's maybe too early to determine whether or not it was the right or wrong decision. But I traded execution for a multiple. And
Mm.
I think had I not been so concerned with optimizing at the time, and I mean, people will say Kibble has its issues now, whatever. I'm comfortable with that argument, but I probably should have just let it be, and I was like, well, this one's stretched and this one's not. And I have a view on the asset base, so I can sacrifice a little on management. And
Hmm.
then it's like, well, crap, why did I even do that? Right. Like my perception of perfect put me in. And it wasn't perfect, but my perception of the need to optimize put me in a scenario where I got myself in quicksand.
And it sounds like, the prioritization, you kind of got the valuation above the management quality, which
Yeah.
which I think,
And I'd argue asset quality.
and asset, right. And I mean, leverage and a number of other factors, right, as well.
Yeah,
I
you can
think all
feel free to
pieces.
keep kicking me if you'd like. But you know what I
If
mean?
you want to
Like,
spend the rest of the podcast on my mistakes, we'll run out of time before I run out of mistakes. So,
well, I could kick you back, and I want you to. I please, if I say anything that's offensive, understand that like you guys are awesome to me, and I'm only trying to say it to learn. But I have thought to myself as I've looked at some of the stuff you've owned, like Dollar Tree versus Dollar General was an interesting choice,
it was, yeah.
and like I don't know how do you think through like when that gap, I mean, this is the art of it all, I think, but how do you think through when that gap in valuation exists and is justified versus it's not?
Well, no, I mean, you're absolutely right. There are a number of examples where, and we can run with Dollar General, Dollar Tree, where in the early days when we first were invested in Dollar Tree, it was a much simpler story than it is today. It was just the Dollar Tree, everything for a dollar concept. And I used to say in those days that I could literally give the conference call. Bob Sasser, who was the CEO at the time, was just very consistent in the message to shareholders. And I think he was very consistent with his message to his employees and to the customers as well. And I think there was a lot of value and power in that sort of very clearly defined purpose. And and then they acquired Family Dollar. And I remember when that announcement was made, looking at the slide presentation, and there were mentions of EBITDA
Hmm.
in that slide deck. And I went back and I looked at every transcript. You can do document search in Bloomberg. So I went back and I document searched every document, every transcript, presentation that Dollar Tree had ever given in search of the use of EBITDA. And it did
Hmm.
not exist anywhere in any prepared comment that they had ever made before. And I thought to myself, well, that's interesting and mildly concerning. Not that EBITDA is such a horrible metric, but it was something new,
It's a focus
and this was a
shift on
it
a
was a shift,
non-cash term that they'd never talked about before.
and they'd never talked. And what it made me think was this idea. I don't know where this idea came from, but I don't know that it came from inside of Dollar Tree,
Yeah.
and I still don't know where the idea really came from. But it made me think that somebody had maybe convinced them that this was a good thing to do,
Hmm.
and that it was sort of taking them away from that really simple idea that had been so powerful over time, and it turned the business into something far more complex. And they've struggled, mightily. It's no secret since that time, and they won that bidding war against Dollar General with a lower offer.
Hmm.
And it was a really interesting case study in maybe game theory, in the way that all went down. But there was a winner's curse associated with that, because Dollar General's business stayed simple,
Yeah.
and they were able to continue just executing on what they had been doing for years. And they have run laps around what Dollar Tree has been able to do since then.
Looking at the
And
locations, it would have been interesting if Dollar General had won because Dollar General's footprint is quite a bit different from Family
mhm,
Dollar's from what I've seen driving around.
the business models are just so much more alike, Dollar General and Family Dollar, than what Dollar Tree was doing. And I think maybe there was some frustration at Dollar Tree because they had become just excellent merchandisers, and they really, and supply chain sort of wizards as well. And so they would go over to Asia and they would find these great products that they could sell at their margin for $1, and then they would basically pick them up at the factory gates and arrange for all of the transportation and
Hmm.
sorting and shipping to the United States. And they were really, really very good at that. But they were coming across in those shopping trips products that they couldn't sell for $1. And that, I think they said, these are great products, and wouldn't it be great if we could have a place to sell these And they had at that time a concept that they were testing called deals, which was a multi-price business similar to what Family Dollar and Dollar General are.
Huh.
And, maybe that was part of it as well. I'm not sure. But you're absolutely right. So maybe, and this is where the art of not selling, I think, if you really wanted to push me on this, right, you would say, and I think you made a comment on a prior conversation about sort of being a frog in boiling water. And at what point do you realize the water's boiling? And at what point in this business degradation process do you know it's time to get out? And if you're too slow to finally come around to the idea, because we say in the paper, it's not the art of never selling, right? It's the art of not selling with parentheses around the not, and that's maybe too subtle. But the idea is we're not selling unnecessarily. We're not interrupting compounding unnecessarily, which is sort of the first rule of compounding, as per Charlie Munger. And so then, what is the right time to sell? It's when the business or people cease to be exceptional in our eyes. And so, at what point did Dollar Tree sort of cease to be exceptional? Was it a year after the Family Dollar acquisition? Was it 3 years after? You would have made a lot more money had you pivoted at the time of the acquisition, purchased Dollar General, sold Dollar Tree, and owned that, and it's been a great business. But that's what's hard about the art of not selling, is knowing when to sell on the business
And
degradation
and the
side.
art of not selling is not like, is there is there ever a valuation? I mean, I have to think the answer is yes, and it's a very hard question to answer, but it's something that I've been fascinated with. Like, it seems as though mathematically, at some point, selling is the right decision.
Yeah.
That said, I mean, I don't know. I was looking up stupid things I've said in the past, and I told you, like, I sold Apple thinking that mathematically I was correct, and my analysis was obviously garbage because it was not the right time to sell. Like, how do you think about, it? We're on the back end of some what people would call bubble valuations coming in. Like, how do you think about, like, when something gets really stretched, just sitting still? I think that's a really like hard skill to develop.
So the answer to the direct question is there is, I think there is a time when valuation can become so egregious that you would sell based on valuation. And I think if you're looking out 5 or 10 years and you can't conceive of a scenario where you're going to generate a satisfactory return, then it could be a situation where you would sell on the basis of valuation. It's just the hard thing is, from our experience, the very best businesses surprise you. They start a new line of business, or there's some enlightened acquisition that opens up a new area of growth, or they are able to expand margins to a place where you never thought possible. We've had businesses that have, O'Reilly, which is a retail business, that's brought its working capital negative and been able to use the proceeds to fund repurchases. I mean, stuff that you would have never imagined. A retailer with negative working capital, how is that even possible, right? And so it's really painful to look back with remorse at a decision to sell what you knew was an outstanding business because it got a year or two ahead of itself in terms of the price. And so, and I think you wrote it somewhere that it's more important to be really sure about the quality of the business than it is to be whether it's 10 or 20% too expensive.
Well, I
And
may have written that, but then I bought Altice. So what does that say about me? But yes, I have gotten to that point, and like I really, I thank you for writing that paper. That paper is something that I've spent a lot of time on, and it's bent my mind a lot. And people have asked me recently, because I talk about Peloton. I like the product a lot,
Mhm.
a lot. And I've avoided the stock. And at the end of the day, the reason that I have is like, I just don't think it's a high enough quality business that I want to own it versus the other universe. And if I didn't study what you guys wrote, I wouldn't have come to that conclusion. And I'd, have gotten waxed on that. So thank you.
Oh, wow.
And the other part of it is so how do you think about these great rates or these great businesses versus base rates? And everybody knows, well, not everybody, but a lot of people know the paper that shows, what all the equity return is from such an infinitesimal percentage of the
Hmm.
market. Like,
Tiny, right?
yeah. So yeah, that's what I mean. Like very small. How do you think about like this is a great business today, but boy, is the competitive advantage period going to go away, or like why is this going to continue? Shouldn't capitalism kill this?
Right. Well, and I think that's what we all are driven by as investors is we have this belief that we're going to be able to pick out. I think you guys were talking about it on a podcast, and the number was 1 in 20. I think, right, that really drive the returns over the long period of time, and we all sort of think that we have the ability to identify that 1 in 20. There's a quote by Richard Koch, something to the effect of most of what exists in the universe, the actions, resources, ideas have little value, yield little result. But then on the other hand, there are a few things that work fantastically well
Hmm.
and have this tremendous impact. And sort of, he states that as a universal concept. I think it absolutely applies to investing. I mean, when you go back and you look at the track record that Chuck and our team has assembled going back to 1989, a dozen or so businesses account for nearly all the returns over that period of time.
Hmm.
Even though the portfolios have contained hundreds of businesses. And so one of the challenges that we face, and Chuck talks about this a lot, is that it isn't always obvious to us right away which businesses are going to be the truly exceptional ones. And they sort of reveal themselves to us over time. So there are these false starts, and businesses that we think are exceptional don't turn out that way. Managers who we think have that unique combo of skill and integrity disappoint us, come up short in one way or another. And so we're always sifting. That's what keeps us going. That's what we love to do. But that's the reason why the portfolio, if you look back over the investment partnership, I think since its inception in 93, it's owned 120 or 130 businesses. But again, it doesn't really have accounted for all the returns over that period of time because a few things work out fantastically well. And what's really interesting about it is some of the businesses that have had the greatest impact over time, like American Tower, for example, weren't sized to be the largest position initially,
Hmm.
but yet they still, over the fullness of the track record, were the ones that really made the difference. And so to me, that's really encouraging, right? Because it means you don't have to get the position sizing right from day one. But it also argues for allowing those businesses, once they've earned that bigger piece of the portfolio, to keep it as opposed to trimming them back. They've sort of righted your mistake for you.
Hmm.
And now you should let them run, I think, within
Yeah.
reason, of course. But I think it's a different story if they've earned a bigger slice of the portfolio because they've grown their underlying earnings or free cash flow per share versus the valuation quintupled or something like that. But yeah, I mean, we start with the idea that there are a few truly exceptional businesses that have durable competitive advantages that will withstand the test of time, whether it's regulation or innovation, competition, and that those just don't come around very often. And that's why when we find one, we try to hold on to it really tight. And because they're so rare, we fill a portfolio. We can find 8 or 10 or 12 of those, concentrate all your capital there, then and have enough sense to leave it alone, then you're in business. The issue is when you bury those exceptional businesses in a portfolio of 100 others that are less exceptional, and then and you sort of trim them as they get to be larger, and you never really let them make that impact.
For some reason, I have this thought in my head, and maybe it makes sense and maybe it doesn't, but it's almost as if, Charlie talks about investing as a pari-mutuel system and thinking about horse
Hmm.
racing, right? It's like
Hmm.
you pay a bunch of if you're familiar with horse racing, you pay the stud fee and then you get a horse and like you have no idea what you have. It's just a small horse and it's all speculation until they hit the track. And it's as if okay, so this really great stud or this really great foal or whatever that you paid almost nothing for comes out and can run like crazy. And then instead of like heaping resources on that young horse, what I think I have done and what I think investors kind of do is like, well, there's this fatter horse that I spent more on or something. So can I turn this fat horse into this horse that is really ready to run? Or you say like, well, boy, this fat horse can like pay me more if it wins. And it's like, yeah, but that thing sucks. Like this other thing is ready to go.
Hmm.
And it's interesting to me how flawed my thinking has gotten at times because I've allowed the odds offered to justify like a fundamentally flawed idea.
Hmm. It's interesting. Well,
Like if you think about it, it's like I have these two horses and it's clear that one is better, but I'm like, well,
right.
the odds are not worth the bet. So I'll just take the one that can't win, but the odds are better, right? And it's like, well, you better size that right.
I think that's the very natural evolution of a lot of investors, where you hear about folks who start off as being sort of deep value investors in the Graham and Dodd sense, because there's a quantifiable value that you can point to and say that's what I'm investing in. And then a lot of these investors go along the same learning curve that Warren went on, and Charlie helped him, and they graduate to understanding that it's far more important to find that exceptional manager and pay a little bit more, that outstanding business franchise and pay a little bit more than than that quantifiable value. And it's sort of replacing the quality, the quantitative with the qualitative, the quantifiable with the unquantifiable, and then you're basing everything on a judgment, and that's you're on much less firm ground when you start doing that, in a sense, right? And you have to trust your judgment and your intuition. I think people make mistakes there, and one of Chuck's favorite lines is that good judgment comes from experience, and experience comes from bad judgment.
Yeah.
And so and that happens. The other thing that he says a lot is, I'm lucky in this business if I learn something new, and I'm doubly lucky if it doesn't cost me too much. The two kind of go hand in hand, right?
I like that one. That one's great.
So, but I think that's a very normal evolution for an investor to take, what you described.
It's tough because that judgment requires self-conviction. It requires like the ability to trust in something that is not, you can't point to it. But I really like your concept of writing down the most important question, because I have to think that that's a good true north to come back to when those judgment questions come up. It's like, okay, does this impact my most important question?
It's what we, it's our, it's our North Star. It's what Chuck is always encouraging us to simplify. He's he's very impatient in a good way, in terms of long drawn out explanations. If you can't articulate in a very short period of time why what you're saying is important enough for his attention, then you can lose. You lose it. You lose it.
Hmm.
You have to sort of earn that. And I think that's because it's hugely helpful to us all. But at the beginning, when I was sort of tepid 24-year-old analyst going into his office to pitch him an idea, and you could tell you lost his interest after bumbling around for a couple minutes. And so over time, you get better at that essence. And even now, he'll say, Chris, that's all really interesting, but I don't think you've really honed in on the essence of this business. And he'll challenge you,
Hmm.
and you'll say what you think is the essence, and he'll be like, no, you're not there yet. And and it's that boiling it down process. And then once you get there, gosh, that's really valuable. That's so helpful to have.
Do you think he knows the essence of the business, or do you think he knows when you know the essence of the business?
So the businesses that we already own, I think he has in his mind what in essence is. And for businesses that are new to him, I think he knows when I've articulated it clearly and in such a concise way that it's probably close to being true.
Huh.
I think he's probably responding more to the length and lack of directness. He's a very direct person. I think he appreciates that directness more than, when I first would tell him about a new software business, I don't think that he necessarily has the essence of this sort of, random horizontal market software business, stored in the back of his mind. But as I articulate my way through it, I think he says, well, you're a lot closer now than you were a minute ago.
Hmm.
And so that's just, and that's, I think, a product of a career in investing. And, fortunately for us, we benefit from that a lot.
Or a story that I liked reading about was you had mentioned a company that you all went out to see, and you were asking questions of the managers around the
Yeah.
CEO, and nobody felt the need to look at the CEO. And like when you're talking about interacting with Chuck and then thinking of that story, he's got to be a good guy at reading people.
Yes. And so I'll tell that story if you
Yeah.
think
As
folks
long
will
as you're
find that
comfortable. I
interesting.
just don't want to like
Yeah,
say
yeah.
anything that you don't want to say or whatever.
No.
Yeah.
So the business. So we were visiting Roper. At the time, it was called Roper Industries. Today, it's named Roper Technologies, and it's a business we still own and think highly of. The Originally, it was an industrial conglomerate, and then the board hired Brian Jellison to be the CEO, and he had this idea that improving the returns on capital for the portfolio would over time improve the stock price performance. And so he began this process of evolving the company, much in the same way that Danaher evolved from being an industrial conglomerate into being sort of this life sciences, high quality recurring revenue business it is today. Roper went through that same process. Rather than the end result being a life sciences recurring revenue business, it's largely a vertical market software recurring revenue business today. But it sort of went on that same journey, and Brian at the time was for much of that was at the helm, and then he very unexpectedly tragically passed away, and the new management team is doing a great job. But we were sitting there with Brian and his team, and this was probably in 2014, so I was only 26 and I'd been here a couple of years, and I thought it was a great meeting. And we got out of the meeting, and the first thing that he observed in the car was the fact that we were asking questions of the CFO and of the president and chief operating officer, and they were freely responding to our questions without first sort of glancing over to Brian to make sure that he was giving them the thumbs up to go ahead and say whatever they were thinking. And then as they were talking, they were clearly not sort of, again, checking back for approval from the boss. And he said, that's a really important thing, and that's a really great sign. And that has been, and so you're right, he's a great observer of people. And then he'll share that little tidbit, and then I took that, and years later, 2018, I was visiting, I won't mention the name of this company, but I was visiting with a company in New York, and it was the exact opposite. There was a chairman and there was a CEO, and the chairman was sort of the big personality, and the CEO was running the business on a day-to-day basis. And I would ask a question to the CEO, and the chairman would interrupt the CEO in his response. he would challenge the premise of my question often.
Hmm.
He wouldn't even just answer the question, but he would challenge the premise. And finally, his phone rang. The chairman's phone rang, and he picked up the phone and he left the meeting. And you could see the relief on the CEO's face when he left the room. And he could answer my questions freely. And I remember my mind went back to the comment that Chuck had made about Roper, and I said, something just doesn't feel right here. And it wasn't any more than that. And we ultimately didn't make the investment. And I think from the time that we met with those guys in late 2018 to maybe a year later, the business had lost something like 80 or 90% of its value. And both of the guys had left. Both of
Wow.
them had been sort of ousted. And I'm not, so was the reason because the founder interrupted the CEO? Of course not, but it may have just been luck on my part. But I'd like to think that that's some of that pattern recognition that you sort of accumulate and develop over time. And so that was really helpful for me. And by the way, I think that's I think that I was reading a transcript in a conversation that you had where you were talking about sort of what is the sort of optimal portfolio. And I think the comment you made was, well, it sort of has to be optimized for me
Yeah.
and my personality. And it's in my
It's
optimal
terrifying how
portfolio.
much due diligence you've done on me.
I have help. I can't take all the credit.
Yeah,
Is
no,
that
that
more
is
or
what I
less right?
said. It's got to be something that I can live with, and I can live with the drawdown. And I really I hope that somebody that's listening to this hears this at the right time. And I know there's pain in the market right now, but I think go to war with the soldiers you can win with.
And I think so. That goes back to sort of the Josh Waitzkin embrace your funk kind of thing, right? So, you sort of have to build a portfolio that is sort of in harmony with your unique disposition, which makes it so that there's never a right and wrong answer as it relates to somebody else looking at your portfolio and saying, well, my portfolio is better. And so, for example, the reason I thought of this was because we're talking about this outspoken founder who is challenging my premise, right, on every question. And so if you say, well, how does my unique personality show up in the portfolios that I build? And I would just say there are plenty of examples of outspoken and boastful CEOs who receive a lot of stock options, who use a lot of leverage, who have compounded magnificently over time, but that's just not my cup of tea.
Hmm.
I sort of prefer the Mark Leonard, Warren Buffett prototype. They're founders, they own a lot of stock outright, not through options. They look at shareholders as a fiduciary would look at a client. So Phil Fisher refers to that as trusteeship. And I really love that word because that's a higher standard, I think, than legally what a management team has to have. But I mean, Mark Leonard will tell you outright when he thinks the shares are overvalued. I mean, how many managers do you know of who will do that?
Yeah.
Warren refused to buy back stock for years because he didn't want it to be predatory because he knew he had more information than the selling shareholders would have. And he's only doing it now because he's making it perfectly clear to everybody who dares sell their shares back to him that he thinks that they're selling to him for less than what the business is worth. I mean, that's just another level of honesty. And there aren't that many folks like that out there, but there are enough of them that you can build a portfolio, I think.
Yeah.
And so, I mean, And in both cases, share count doesn't go up. I mean, there have been 21 million shares outstanding at Constellation Software since 2006. They're not diluting the shareholders. So that's how my own unique disposition sort of, I find it offensive, and I'm just off put when there's sort of the boastfulness or putting down competitors openly, that sort of thing.
I wonder if that doesn't upset me so much because I like hip hop. There's the guys that talk shit and back it up don't really bother me, but I will say that I do try to keep a pretty open mind and my eyes fairly open that, like, if push comes to shove, where do I sit in the equation here? Because I think there are certain people that I think you got to be aware that you're probably on the lower end of the priority list than others.
Yeah, I mean, it's one of the interesting questions about some of these software businesses today, because in the old days, what were shareholders? They were capital providers for a business. And so they were a necessary partner for growth over time. But if you have businesses that generate enough cash flow that they don't really need shareholders to play that capital provider role, they're more of a liquidity provider. It puts shareholders in a fundamentally different position than they've been in historically. And I just think it means that you have to be even more discerning about who you partner with as far as the management team goes, and how they view you as a shareholder.
I like how you said that. I think with share-based comp, it's almost as if the employees are the people willing to finance the growth, and the role of the share price is to keep them interested in working there. Mm-hmm. I thought an interesting interview or article that came out today was apparently like Peloton's employees are watching the share price crater. I can assure you that happens everywhere. I think managing through a really volatile stock price would be a very, very difficult endeavor. I know at BMO, I mean, our share price was not particularly volatile. Everyone knew when it was down. I mean, people talked about it constantly. Maybe not everyone, but enough that everyone in the office knew what the share price was doing. So it's interesting.
It's a risk factor. I mean, if you think about, I believe if you read the Salesforce 10K, there's a risk factor in there that has to do with being located in Silicon Valley and having such a competitive labor market there. Because I mean, that is a factor. If the share price declines meaningfully, then you have an unmotivated labor force who can very easily, take their skills, which are your assets at the end of the day, right out the door and go over someplace else, which has a more promising trajectory and is willing to issue options. And so it's a real conundrum. We do a lot of software research here, and we sort of, all else equal, would rather find businesses that aren't located in some of those really competitive labor markets. I think it changes the dynamic a little bit. Yeah. Maybe a little bit less mercenary.
Yeah, that makes sense. And then the other thing that stinks, if you have such competition, when things go bad, you probably have to pay people a lot more to stay. And it's like one of these negative cycles that can get going, at least from the minority shareholder liquidity provider standpoint.
Yeah. Well, and it's one of the cases where the sort of stock-based comp add back, with the sort of the idea that it's a non-cash item. Well, to the extent that non-cash item is replaced by higher cash payments, then it really becomes an expense quickly, right? And so it can contribute to the sort of the downward feedback loop that you're talking about there.
Yeah, it's one of those things that doesn't matter until it matters.
Mm-hmm. Yeah.
How often do you, like, personally or as a firm, think about macro and what's going on? And part of why I'm asking this is, we're at this period where on Twitter Spaces, people are saying this is, the correction of the century is coming. SaaS is correcting. that's going to rein in spending. All your AWS assumptions are completely bogus because it's based on inflated VC spending. And like, it's a very elegant theory. I think there's probably an element of truth to it. I think that the probability that that results in the crash that is the end all be all crash is very low. But like, there's this there's a tension between there's something smart being said versus it doesn't matter versus like, when should I pay attention?
So when you think about, so the answer is, we think about some of those big questions less so when you say macro. We're not, of course we're paying attention, but we're not really, we have no view on the direction of GDP or inflation or interest rates. And ultimately we're trying to invest in businesses that we would classify as sort of all weather, who are not subject to exogenous factors like oil prices or inflation in that same way. I think, a lot of our clients recently are asking us, how is the portfolio positioned to withstand a higher level of inflation? And whether that's MasterCard, where it collects a basis point, a number of basis points on the dollar volume. So as the dollar volume rises, as inflation, it adjusts
It's a
their
nice
revenue
hedge.
automatically. It's a very nice hedge. American Tower, a number of their contracts have pricing escalators built into them, either fixed or based on inflation, depending on where in the world you are. And then there's just the good old fashioned pricing power businesses. And so, we try to position the portfolio that way, so you have that all weather element that can withstand. And that was a lesson for me. Talk about my mistakes. Earlier you said Chuck told you that the next American Tower is probably American Tower. Well, years ago, I thought that the next Danaher was a business called Colfax, which was founded by the Rails brothers, the same guys, Stephen and Mitch Rails, who founded Danaher. But the difference was that while Danaher had moved towards these recurring revenue businesses, Colfax was still in macro sensitive businesses that were highly sensitive to swings in currencies and commodity prices and just general GDP growth. And so, that was a painful lesson for me, and the importance of being all weather. And so we don't think a lot about the macro in that sense, but we do think about some of these big questions that you're sort of alluding to. So for example, just let's talk for a minute about SaaS multiples. What do you think about the because if you look at a historical chart of software multiples, I mean it's pretty sort of
Stretched relative to
mind
history
blowing.
is not
Yes,
that's not controversial. That said,
that's a fair way of saying it,
yeah,
right?
corrected a fair amount when you factor in sales growth and multiple compression today.
Yes, right. Yes, we're working, and so we would think about, so the what we would think, and this would be my version of macro, is I would say, so there's absolutely no question that some of the multiples that you're seeing now are implying substantial growth for a long time to come. And I understand why investors are willing to pay those multiples, because if you look at a business with a 98 or a 99% customer retention rate and you extrapolate that, you're going to be in business for a very long time. Of course, the problem is the extrapolation, and you just have to be really confident that there's not going to be some sort of adverse change in that retention rate in the future. And what you're essentially doing, especially with the sort of yet to be profitable software businesses, is that you're essentially underwriting management's assessment of customer lifetime value.
Yeah.
They're laying out the cash today in the form of either new customer acquisition expenses or product development, right? And they're justifying those investments based on an expectation about future customer retention. And if they get that math wrong, then there could be a lot of sort of shareholder value destruction taking place, but you don't know it yet. It's a lot like an insurance business. You don't really know the wisdom of an underwriting decision for multiple years a lot of times in the insurance business.
Yeah.
And
Yeah.
so we
Longer
think
tail,
about
right?
longer tail. And so that's a macro issue that we think about. We ask the question, is it possible that LTVs are harder to come by today than they were 20 years ago when SaaS was first taking share from a lot of the on-prem solutions back then? Because there's just more competition. There are more, young, bright folks who are receiving a lot of venture funding, trying to disrupt the existing software providers, because now there's a better appreciation for how fantastic these businesses can be. And if so, what does that mean for the current vintage of early stage unprofitable software businesses? Can you just apply the sort of long-term 30% operating margin end state to all of these businesses? That's a question. That's the kind of macro-ish idea that I would wrestle with. And of course, there is no answer. I don't know the answer to that. I'm in Middleburg. I'm not in San Francisco, so I'm probably the last person you want to ask, for the answer to this question. But that's what I'm wondering about. The way I answer it is on a micro basis, and so we own a number of software businesses, but the average multiple EBITDA margin for our software business is in the 30s, right? So we've sort of tended towards the more mature.
Yeah, let it prove out, and then you can
Yeah,
analyze what it's probably going to be at end state rather than making guesses.
yeah.
I got nervous, and maybe to my detriment, maybe not, but I have a buddy who has a lot of friends in Silicon Valley, ran his own company, and he said to me a little while back, he said, I have friends that are hiring engineers at a pace that they know doesn't make sense. But they
Mhm.
also know that this is maybe one of those times that they can make generational wealth. And people want to see engineer hiring, and they also want to see growth. So, like, how much of that decision one, how much of that anecdote is reality? And two, how much of that decision making is driving growth forward? Whereas, in like a real world scenario without those incentives and maybe stocks correcting takes away some of those incentives, what does growth look like then? They're unanswerable questions from my seat, but it's what has kept me away in certain instances.
It's really hard. I don't think accounting conventions help us very much. It would be, you look back, and I think Michael Maugusin has done a really nice job recently in helping us think about this issue, which is back when, Walmart was a young business and was growing quickly and was opening all these stores. They were able to capitalize and then depreciate the cost of opening those new stores over what they thought was the useful life of that asset that they were investing in. And so you had a version of the financial statements that was a little bit more useful and sort of forward looking than what we have now with a lot of the businesses out there that are investing through their P&L and their income statement, because of course there's a little bit less flexibility around. I mean, there are obviously investments in product development that are happening that will benefit these businesses for multiple years, and they're being expensed entirely in the year incurred. And I think the same holds true for sales and marketing. And so if there was a similar concept as useful life of those assets, and the businesses were thinking in those terms and reporting financials in a way that helped investors think in those terms, it would be really useful from my point of view. We can make those assumptions, but you're stacking assumptions upon assumptions upon assumptions at that point, in an attempt to get to what we would consider sort of owner's earnings. It's just more difficult.
Yeah.
I don't know and so he put out a paper, I think, where he looked back and he said, look, we think that this percentage of sales and marketing for the average business over this period of time could be capitalized and depreciated over this amount of time. And you can take that and apply it. And I think that's helpful as sort of a base framework. It definitely is pointing you in the right direction, I think, but it's still really hard.
You know what's tough
because
about
again, it's
that for me too, though, is like, okay, fine, I agree with that. But like, if it is cultural, I think I don't know what I'm talking about here. It's all speculation, but I suspect in these high growth companies, it's cultural to go out and win, and it's cultural to go out and I don't want to say overspend because that's not the right way to frame what I'm trying to say. But if tough times hit and the stock price comes down and some of the expenses come in, like to what in human organizations, that stuff can, it feels like it can break when there are substitute companies to go work for,
mhm,
right? Like at Accenture, that's kind of like a business that people are going to stay at. I think it offers a
mhm.
good quality of life and it's enterprise sales, business to business. Like I don't worry about everyone from Accenture moving to the next big consulting firm, but some of these SaaS sales forces, I do worry about the turnover, especially with how much money you can make if you're good at enterprise sales. It's crazy. It's what I should have done. I feel like I could have been a pretty
Yeah,
decent salesperson had I started
should have
20 years ago.
write code.
Yeah, well, that ship has sailed. I'm trying to get my kids into the Minecraft, the one that you can code, and I think I got a reasonably good chance at doing that.
And if somebody asked me today, somebody young and said, blank slate, I could be happy doing anything. What should I do? I'd say, I think you should learn how to write code.
Yeah, yeah, it probably would have been a better use than like trying to learn Spanish for me. Just because like I grew up in South Florida. If I had just gone to Miami more often, I probably could have picked it up, but I didn't use it enough. So, oh well. Such is life. There's a better use of time than Latin for me. You know what I like reading? Just like I'm jumping around here, but you said something. It's important to cultivate quality as a way of life.
Mm.
And listening to you talk and listening to your selection process and stuff, I like how I'm going to call it simple. It's not simple, but it is, in my opinion, what you've articulated today is taking an idea and taking it seriously. And I respect that a lot. There's a lot of discipline in how you guys go about your business.
So you said the Q word, quality. And so I kind of have to preface this by saying I'm a member of the Robert Persig fan club, so to speak. And so we can go down a rabbit hole on quality, static versus dynamic quality, and the balance between the two of them, and how that applies to investing
Yeah, let's
at
do
some point.
this.
That's but but I think, yeah, I mean, I think quality and discipline are, I think, if I had to pick sort of like four words that would describe, because at the end of the day, you think about this and you say, well, what value do we bring at the end of the day? Like, what does Akre Capital bring to the table for our clients that they couldn't do on their own? And I think it's quality, it's discipline, it's focus, it's compounding. Right? Those are sort of the four words that you would say. Quality relates to our judgments about business quality. And so hopefully over time, cumulatively, all of our experiences put us in a better position to judge which businesses are of higher quality than others, which management teams are of a higher quality than others. The discipline piece relates to valuation. And Chuck talks a lot about being an investor in the underlying value of a business as opposed to the speculator in the price movement of shares, right? And so waiting until the deck is sort of stacked in your favor to buy some of these outstanding businesses. Focus is just managing concentrated portfolios, and we've talked about that. And then the last one is the compounding, which is a mindset, and there's a lot of discipline that's kind of around compounding. And I would tell people it's always been harder to convince Chuck of the wisdom of selling a business than of buying a new business for the portfolio. Always. But so if we had this portfolio and there were 20 businesses in it, and I came to him and I said, here's something new, you've never heard of it before, I think we should make an investment here, the bar would be lower to get that new business into the portfolio at an equal position sizing, let's say, as taking an existing position at that same size and exiting it.
Hmm. And that's because he already knows what he owns with what he owns.
He knows what he owns and he knows the danger of selling. He just knows. And so I don't, not to go backwards and revisit all that. I'm just saying that is a
No, we can, because this is
ingrained
important.
mindset. That's just, I think, and that's something that you as a professional money manager can sort of bring, I think, to the table. And so anyway, that's how I would think it, sort of what is the value add that we have is sort of captured in those sort of four words there.
Do you think so? Is a tangential thought to what you just said? Is that why holding a business at a valuation that you maybe wouldn't buy the business at?
Mm-hmm.
It's just kind of the default. Like, look, I know that I I believe I know with a fairly high degree of certainty that over the next 10 years this is going to work out. So if it's a little overpriced today, who cares? We bought it better. Just let them do their thing.
Mm-hmm. Exactly.
Yeah.
Yeah, for sure.
That makes sense, man. I wish I had learned this like 10 years ago. Oh well.
It's hard. I mean, and so the practical reality is that in the last 12 months, I've sold a couple businesses. So even being armed with all of this and having Chuck sit 20 feet in that direction from me, right? And having worked with him for 10 years at this point, there still are times when you sell things and you face all of this stuff and you try to process it and make a good decision, and sometimes you get it right and sometimes you get it wrong. So it's still really hard. I think it's the hardest thing we do. Next to, I think evaluating people may be the hardest thing that we do, but then the next hardest thing is when to sell.
Hmm.
Those probably be the two hardest things, because people can be tricky.
Yeah, there's no flashing light that comes on a huckster, right?
No, no, and they're actively trying to deceive you, and so that makes it harder.
Yeah.
Or they have some self interest that's opposed to your own, and so
I'll
seeing
tell you what
through
I've
that.
noticed, man. I think sometimes people are attracted to the fact that I'm honest. And it's like, well, I have a lot of warts, like, and then people will say to me, like, you're wrong on this or that. And it's like, I know, like, I don't know what to tell you. Right. But sometimes I wonder if in the evaluation of people, it's like, well, what I like about this person might be the reason that I shouldn't listen to this person. Right. Or
Hmm.
whatever.
There's just the
Or I should
slick and the, yeah.
yeah, or I don't know. It's weird. I have another buddy who, on Twitter, he picked up like a bunch of followers because he talked about like how badly he had messed up, and he did it for himself. And he wrote me, and he's like, "It's crazy to me that people are following me because of everything that I've done wrong." And I said, "Well, I think it's really that people appreciate somebody being able to say that they did something wrong,
Yeah.
but that there's like that emotional tie of liking that quality in a person can maybe lead to other conclusions that are
Hmm.
incorrect.
Sure.
I don't know, right? But it's just reading people's stuff.
Reading people, and I think for me, I I think what we're all looking for is authenticity to some degree, which is kind of gets at the heart of what you're talking about. Was that enough? Is somebody who says, look, I'm sort of self-labeling yourself as humble is one of those sort of challenging things, right? Because is that authentic, or is that done with some other motive in mind? And
Yeah.
it's so hard to, it's so difficult to accurately assess people. And I think it's iterative. It's sort of like dating, and you get to know these managers better over longer periods of time. And that's another reason why, if you feel like you've invested the time and do have that confidence in a management team, let's say, for example, this comes up a lot. You invested in a business, and 10 years later, while it was growing at sort of 15% per year when you first made the investment, now it's a much more mature business and it's growing at 12. And you're trying to decide whether or not to move on, and you found something else new that's growing at 15. And so you can kind of recover back to that original higher growth rate and keep the portfolio's weighted average growth rate at that higher level. But it means starting that process over again and having to learn a new team. And do you trade that 12 that you feel really good about? That the distribution of outcomes around that 12 is pretty narrow in your mind because you know the people and you know the business really well. And now you're going back and sort of resetting the clock, and you've got a wider distribution of outcomes, and there's the uncertainty around the quality of the people. And that's a really hard decision. At some point, if the goal is to generate above average returns over long periods of time, and 10 is the average, and you're charging fees, you can't let it get too far below 12, right? But that becomes really hard. That becomes the challenge with owning something like Berkshire, for example, for us, because it's just below that hurdle rate. If you think it's going to grow at sort of a market like 10% over a long period of time, but you have absolutely no questions whatsoever as it relates to the integrity of the people involved, at least at the top.
Yeah. That particular business, the only thing that keeps me up at night, and if anyone works for Berkshire or any portfolio company, please reach out to me. Bill Brewster TBB on Twitter. Like, do people go to work for Warren and Charlie, or do they go to work for Berkshire? And when Warren and Charlie are not there, what does that look like? I was fortunate to meet Ted Weschler for like 2 seconds, and that guy is like a gem of a person. I mean, I like within a second, I was like, I like this guy. So if Berkshire is filled with that, then I'm not too concerned, but I don't have insight into whether or not it is, right? I can just take Charlie and Warren at their word, but they're not going to sit there and tell me that their baby's ugly. Like, nobody says that.
Sure.
So we'll see.
Well, it's gotten so big. I mean, your question is an interesting one. Do they go to work for Warren and Charlie? Do they go to work for Berkshire, or do they go to work for one of the subsidiaries? Where is the sort of sense of identity?
Yeah, that's right.
As you get to be that big.
Yeah, like I know a family that sold to Berkshire.
Mm-hmm.
I don't know that their tie is like, so the man that started the company is older. Warren and Charlie are older. I don't know that the family's tie is to Berkshire in the same way. So you've got layers of succession planning here to worry about. It's not just one. That can get complicated when growth is also slow on top of that. Your skew can get out of whack. I
And I
say
think
that
as
as it's a
businesses
big
get big,
holding of mine. So it's
yeah,
something
no,
I haven't acted on this, but it is something that keeps me thinking throughout the day. That would be my most important question. Can the engine continue to run when they're gone?
and there you go, right? And so any hint that you get that is helpful in answering that question, you realize that's a really important piece of information, and then everything else you can kind of move past.
Yeah, that's right.
That's why it's such an awesome exercise.
It's a good way to lead into the idea of quality being static and dynamic.
Oh yeah.
You want to go down that rabbit hole real quick?
Okay, so Robert Pirsig wrote 2 books, right? There's the Zen and the Art of Motorcycle Maintenance, and I wrote a piece called Advice for Aspiring Investors. It's a white paper, and it's on our website. And the reason I wrote the piece was because younger, sort of college-aged students were reaching out and saying, "What's your advice as far as sort of getting into the investment business?" And I found myself repeating a lot of the same tidbits over and over again. So I said, let me write this down and I'll put this out there, and then at least maybe it could help some more people and save me from repeating myself. And it kind of, anyway. So, and in that I include a list of reading books, investing books that I would recommend. And a few people have looked at that list and they've noticed that Zen and the Art of Motorcycle Maintenance is on the list, and they say, well, that sort of surprised me, because what does that have to do with investing? And I also have Josh Waitzkin's The Art of Learning on that list, which isn't directly applicable to investing. But I think the bigger concepts apply. And I know that, for example, Nick Sleep sort of references some of the metaphysics of quality in some of his letters, and that's sort of Robert Pirsig's invention. But the reason why Zen and the Art of Motorcycle Maintenance is important, I think, is because, as we talked about a couple of minutes ago, one of the things that we bring to the table is judgment about quality of businesses and of people. And what Zen talks about is how to think about quality. It helps us think about quality, this issue of quality. And then both in terms of the object and of the process. So I have I have it framed on my desk, and it says, this is a line from Pirsig. It can be at a level as simple as sharpening a kitchen knife or sewing a dress or mending a broken chair. The underlying problems are the same. In each case, there's a beautiful way of doing it and an ugly way of doing it. And in arriving at the high quality, beautiful way of doing it, both an ability to see what looks good and an ability to understand the underlying methods to arrive at that good are needed.
I like that.
It's just an absolute gem from my point of view. It's the importance of, and so as an investor, we both need to understand what looks good, but we also need to understand the process required to arrive at identifying that good, that quality, that business. And so that means looking at the sort of elements of competitive advantage and having sort of your business quality checklist, if you will, which I think most people have either explicitly written down or in their mind. But then also, how do I make my process? How do I sort of structure my day in a way that maximizes the likelihood that I'm going to be able to identify quality when I encounter it? And that, for us, those are process questions, and that involves the MIQ, the most important question. That involves the essence statements. It involves decision journaling and writing and focus, which is super, super important for me. I'm naturally an attention deficit sort of mind. And so I can't have a lot of things going on at once. I need to be really focused on just one thing, and trying to get down to what really matters in a situation requires my sort of exclusive focus over time. And so that's why Zen and the Art of Motorcycle Maintenance is really interesting to me. And then what Robert Pirsig did was he wrote a subsequent book. I think it was like 15 or 16 years later, called Lila, which is not.
I never hear this interest or mentioned.
Yeah,
interesting.
And this is the more important of the two books.
Really?
Yes.
Huh.
Because in Zen, he talks about quality, but he refuses to define it. He says you sort of would know it if you encountered it, but there's no way to define it.
Huh.
We're getting like really philosophical now. But
yeah, well, it's like the Supreme Court's definition of porn.
Exactly, right? Or if you show, his example was, if you're in a classroom of young students and you read a good essay to them, but you haven't taught them about construction of arguments, intros, body, conclusion, any of the structural pieces, but you read them what is a good essay, and then you read them a not good essay, they know which one has quality and which one doesn't have quality.
Yeah.
So his argument is that quality sort of precedes language and the ability to define it. So he refuses to define it. So that's really not super helpful, though, because he's not giving us much to work with in that way, right? So you're sort of left with this idea that you should go pursue and cultivate quality, but you don't exactly know what that means. And he kind of tries to splice it in a couple different ways, classic versus romantic, and these different, but it's not super helpful. And so then he writes the sequel, Lila. And in Lila, he explains, I think, in a much better way, how you should think about defining quality. And he categorizes quality in two separate ways. He has static quality and dynamic quality. And the way there's an example in there, an analogy, a metaphor where he says the first time you hear a song, you're walking down the street and a car goes by and they're playing a song and you love the song. It's the first time you've heard it and there's just something you love about it. That's dynamic quality.
Hmm.
It's newness. Okay. You listen to the song a few more times, and every time you listen to it, maybe you're a little bit less enthusiastic about it than you were the first time. And it gets to the point eventually where you know it's a good song, you like listening to it, but it doesn't have that new energy that it had at the beginning. That's static quality.
Hmm.
And so and if you have only dynamic quality, then you have chaos. And if you only have static quality, you have sort of degeneracy. It's
Hmm.
not you can't have just one or the other. The whole idea is you want to have some balance of the two.
Hmm.
Okay. This is like, again, this is a lot of philosophy. So then how do you bring it back to investing? Well, you think about businesses, and you can think of, you pick any business and you say, all right, where do I think on the spectrum of sort of static to dynamic this business falls? And then the real question is, do I think that they have a good balance? Are they out over their skis trying new things that have never been shown to work well before? And maybe that means there's too much dynamism, too much dynamic quality there, and you're taking a lot of risk as the investor. Or maybe there's just not a lot of sort of cutting edge thought taking place. Things are just too static. And so you would say maybe it's out of balance in that way.
Hmm.
And there's maybe risk of being disrupted. And so you really can bring this sort of metaphysical idea of quality to investing, if you want to. And I have a few sort of investing friends who we love to kick this stuff around and find it really interesting. It's definitely out there. They're two of the more difficult books to get through, I realize, but and then the great thing is you can apply this to your life outside of investing as well, which is great.
This is probably the top for this poor stock, but as you were talking, I think about Google and their philosophy where search, I think, I mean, I don't think it's actually static quality because I think it still is amazing as it was the first time I found it. But the idea of continuing to focus on some of the moonshots and the other bets and keeping that energy in the organization, it's got this natural tension. It's top of mind for me for a number of
No,
reasons, but
precisely. I think that's exactly the application.
yeah, it's
100%.
cool.
I think that's, and so you would ask a question, you'd say, we talked about charter before. Like, what's the balance of static versus dynamic quality in a cable company? How much does it need? The balance will be different for every business.
Yeah.
Or, there are a lot of sort of innovative businesses out there right now that are publicly traded, very, very innovative, sort of on the cutting edge, maybe not very profitable. There's a lot of excitement around them. And then from an investable point of view, you just look at them and you say, is keeping in mind that all dynamic quality is sort of chaos, does that, how does that sort of work its way into what you're thinking about? And it's a judgment call. Everything at the end of the day is a judgment. Persik's not giving you the keys to the kingdom in terms of making the judgment call, but he's kind of helping you think about it in terms of a framework that could be useful.
Yeah, I like it. I mean, Google obviously resonated, but going back to Charter, one thing that I like about that, right, is what I like about what you're saying as it pertains to that particular entity is they are using a current asset base and wireless agreement to penetrate the wireless market to move the company forward. If we circle back to Altice, that had an MVNO agreement with Sprint, which is not quite the same, wireless offering, right? And I was kind of relying on a low multiple and a static, again, it's not quite precise, the language, but like static quality. But I, I, I traded an entity that I think is going strategically in a better direction with a better set of assets, and one got hurt. So I really like this concept. I'm going to have to noodle on this. I may write you about this if that's okay,
Yeah.
because
Well,
this is interesting to me.
so the other thing you look for, so now I got your attention, you're kind of interested in this, is, there's always somebody who does the new thing first. The first person to eat lobster. But somebody had to be the crazy person
Yeah,
who's
that
like,
person was
"Holy shit!
insane.
Yeah, what are you thinking?"
Yeah,
Like,
the first guy lost his finger. The
yeah,
second
yeah,
guy ate
right,
the
exactly.
lobster.
Yeah, right. So the first guy, yeah, and so so that so you're it's sometimes fun to look inside of one of these businesses for that first person.
Hmm.
Who's the who's the instigator of change? Who's the person who's challenging the sort of accepted collective wisdom? And sometimes that can help you determine whether or not there's a good balance of dynamic and static quality. If somebody in a position of authority is that figure who's open to new things and is always innovating, is probably a good way of thinking about it, then there's probably a good amount of presence of that dynamic quality. If you can't find that any place, at least in the top ranks of the business, then it's fair to ask where it might be at all. And so you can and there's quite a bit of discussion about that, I believe, in chapter 9 of Lila, if you wanted to go in there. The way to read Persig, by the way, just because I know there are probably a bunch of people who've tried and failed to read it, because I did the first bunch of times. You read the first few chapters, then you read the last few chapters.
Huh.
So you read the first few chapters so you kind of get a lay of the land. And then I like to read the last couple chapters, because then you know where he's going,
Yeah.
which is really helpful. And then you sort of attack the middle.
Yeah, you can watch how he weaved it together.
Yeah. And it just, otherwise you read it and then you got to reread it. Because it's only after you finish, you're like, okay, I kind of see where he's going with this. And now I have to go back and reread the beginning part because I didn't comprehend what all that meant. So if someone's listening who's struggled to make sense of these books before, reading them just sequentially, chapter by chapter, I might try to do it that way instead.
Thank you for that tip. I got to be mindful of your time, and also, I mean, we're coming up on 2 hours, but I do want to circle back. What are the last things that are transcribed in the crown molding in the conference room?
So we've already covered the bottom line of all investing is rate of return. We have focus, and there's an Albert Einstein quote: "Everything should be kept as simple as possible, but no simpler." Which, there's another quote that I absolutely love, which is Yvon Chouinard, who's the founder of Patagonia. And he says, and I got this framed over here, it says, "If it seems to me, if there's an answer, it lies in these words: restraint, quality, and simplicity."
Yeah, I mean, this is the essence of what I have gathered from talking to you. That is a very good quote for you to have in the office.
So I leave you, if there's a good quote to leave on, we'll leave on that. And I just have to thank you for this. This was a lot of fun.
Oh, please, man. I'm honored to have you. The fact that you want to talk to me is like a dream come true for
No,
me, and I'm not even blowing smoke.
There aren't a lot of people who will talk to me about the metaphysics of quality, and and Josh Waitzkin, in the same conversation, we talk about the art of not selling. So from my point of view, there's just no more enjoyable way to spend a couple hours. And so I really appreciate it.
Well, I appreciate you stopping by, and I'm sure that there are a ton of listeners that will as well. So thank you for your time.
Great.